if there's anything you've been wanting to look back on, those should be there now for you. Okay. And the other thing I want to say before we get into tonight's content, I was looking or thinking through the, where is it? Next week's class. And I have a class scheduled for November 11th, but I believe that's Veterans Day, and I don't think we're supposed to hold a class on Veterans Day. And so what they have in lieu is a class meeting on, I want to say that following Tuesday, because we also wouldn't have class on Thanksgiving. Let me, I probably should have this better figured out, but let me just take a quick look. Academic calendar. Come on. I think what they're contemplating here is that we don't have class on November 11th, but I thought they showed us a makeup day here. Huh. Well, maybe I'm dreaming. Okay, well, my bad. I thought there was a makeup class here, but I'm not seeing it now. I guess I was hallucinating. So what we're going to have to do, just looking at the syllabus and looking at the time we have left, and now we have a holiday next week. I'm obviously, we're getting kind of behind here. I may end up having to record a couple of these lectures, and you're going to have to look at them on your own, and we won't necessarily be able to go through them together. And then, of course, I'm here for questions. So I'll be letting you know which of these, and I'm going to kind of do it strategically as to areas that I think you might be able to handle with just the recording versus areas that we should go through live together. And then we do have a little bit of fat here towards the end for the final review time that we can probably finish up some of these chapters during that time as well. So bottom line, and I apologize for, I thought I saw somewhere where there was a makeup date for the holiday. Bottom line, there will not be class next week. Let me say that again. There will not be class next week because of the Veterans Day holiday. So no class next week. We will reconvene on the 18th with chapter 5. We'll start with chapter 5. Question? Okay, good. So no class next week because of Veterans Day, due to the Veterans Day holiday. And that means that it is important for us to finish up chapter 4 tonight. Okay, so let's jump into that with no further ado. Let me do my little annoying process of trying to flip over to tablet mode. Okay. And what I want to do, we're going to start to talk about now the process of consolidation. So remember, if we own less than 20% of the stock. We're going to be following the fair value through net income method for our investments. We go past that 20% threshold. We use equity method. We get past the 50% threshold, we start having to consolidate. Okay. And we were talking, I think it might have been, right up to Halloween, and I talked about this scary picture here of the hand reaching out and pulling in the subsidiary into the parent. So ultimately, we're looking and we're ending up with the financial statements of the parent with, and some companies have more than one subsidiaries, with under any subsidiaries that are under the parent's control pulled into the financial statements of the parent. Now, we went through this little example and I kind of wrote it up there, and then I thought, well, it might be worthwhile to go ahead and put this up on the screen here as an Excel file. And I also posted this under F4, but we went through this last time, but let's just go ahead and revisit the little example I had, where let's say I'm a person that's, getting into the restaurant business and I'm trying out different restaurants to see things I like. And I come across this restaurant that I think, man, this is great. This place is exactly how I want the food at my restaurant to taste or whatever. I look around, the equipment and stuff is very cheap. And I'm thinking, this equipment probably has a fair value of $50,000. I'm going to offer the guy $50,000 for everything he's got. Restaurant, recipes, everything. And the guy comes back and he says, hang on a minute now, I've got quite a bit in this business of goodwill. People come to my place because they know I've got good food here. You've got to pay me more than $50,000. So we go through some negotiation, and finally I decide to pay the guy $1 million for all the stock of his restaurant. Okay. So when I do that, I acquire all the stock that they have. They have $50,000 worth of stock. I acquire all of it for $1 million. So I go ahead and I debit the investment on my books, on the parent P's books, $1 million, and I credit the cash. Now, of course, after that transaction, my cash would be what? Would be zero, and my investment account now would be what? Would be $1 million. Okay, now that's on the parent's books. Okay, then I want to go and I want to do the consolidating entry right after the acquisition. Okay, so what do? I'm going to get rid of all of the common stock now of the subsidiary on the consolidated financial reports, because those people are gone. That was evidencing their ownership. I sent them on their way. This guy's living in Hawaii now or whatever with this $1 million. I took his stock, and right now I'm representing it in the amount of an investment, but I'm going to get rid of the stock because there is no more another company that has stock out there. We're all one company. So I go ahead and I debit the common stock for $50,000, and I put the consolidating entries up here, and these would exist on a worksheet. I debit that to get rid of the stock. There is no more separate company that I have an investment in. So I go ahead and I credit that investment account to eliminate that entirely off of the consolidated financial statements. Now, of course, my journal entry has to balance. I've gone and I've credited the investment for $1 million. I've debited the common stock for $50,000. And that difference between what I paid for the investment and the stockholders' equity, the book value of the company, is all considered goodwill. And so I go ahead and I not $1 million, but I debit the goodwill for $950. Okay, I'm just writing that in just so you can kind of see how the process went. And when I do that and I debit goodwill for $950, I'm just going to put the goodwill over here so that it all lines up. So I debit the goodwill for $950. And then when I do the consolidation, now on the consolidated financial reports is where the goodwill will show up for $950,000. Okay, and then I simply add across. The cash is what? The cash is 0, the investment is 0, the equipment is 50, the goodwill is 950, and I have the common stock and the, now why is that not balancing? What did I leave out? This worked the other day when I did it. What the hell happened? Need 1,500,000. What did I do? My balance sheet didn't balance to begin with. Is probably the problem. I forgot what I said last time. Did I have equipment of 500,000 last time, I think? Okay, well, whatever, we're making this up. So my equipment is now what? My equipment is now 550. I think I forgot to put on the example I gave you guys last week, I had the equipment of 500,000. I forgot to put it there. So now what? Now I have my balance sheet should balance now, right? Okay. Question? Okay, now as we go through this, are you guys paying attention? Okay.
Yes.
Okay, so now as we go through this now, I just want to make sure I have something not balanced. Yeah, 1.5. So as we go through and we talk about the consolidation, we're going to add more elements to the consolidating journal entry. But what we're going to do is understand these elements one at a time. The point of this quick little example is just to get you the sense of a couple of important things. One, we get rid of the investment account. Two, we get rid of whatever the stockholders' equity was of the subsidiary at the time of acquisition. Whatever that was, that disappears. And then any difference between the fair value and the book value of the company needs to be brought on. Any difference between the fair value, I should say, and the acquisition price needs to be brought in as goodwill. And that's what we did here. Okay. Okay, good. So you come over, and let's just go ahead and we can close that now. I don't want to save it. And let's just look at the acquisition price. Okay. And the only point on this discussion here is I put this into full screen mode. Okay, the only takeaway here is that you use whatever the price was when you finally close the deal. So you'll announce an acquisition and you may have a stock price, and if it goes up, you use the price when it closes. If it goes down, you use the price when the deal closes, not when the deal is announced. Okay. Okay, good. Now we start to take a look at the consolidating journal entry. Okay, and let's look at these elements one at a time. And I just want you to keep in the back of your mind the little example that we had as we go through this. Okay, so what happens? The pre-acquisition equity, the common stock, in our little example, we only had common stock, but the common stock, the APIC, and the retained earnings of the subsidiary is not carried forward in an acquisition. You will eliminate that entire amount, okay? The investment in the subsidiary is eliminated, and you saw that in our little example, okay? Then you come down and you have to bring on goodwill. If there is an excess of the fair value of the subsidiary, acquisition cost plus the non-controlling interest over the fair value of the subsidiary, then the remaining excess is debited to goodwill. There was no non-controlling interest because we bought all of the stock. And I assumed in that example that there was no difference between fair value and book value of that equipment. Now, the balance sheet, if there was a difference, would be adjusted to fair value at the acquisition date. First, you would go there. Then if there were any intangible assets, you would allocate any difference between the book value and the fair value for the intangible assets. And if there's any non-controlling interest, you need to bring that in, okay? So when you look at this, you really need to understand these things one element at a time, Okay, and so that's what we're going to do. We're going to spend time tonight understanding these elements one at a time and how we would put together the consolidating journal entry. And then we'll talk about, things that happen after that consolidating date as we start to eliminate. And primarily the focus there will be on intercompany transactions that will primarily be eliminated.
Sorry. How are the costs of the acquisition? Because usually the investment bankers take a hunk and there's usually some fairly sizable costs associated with an acquisition. Are those considered part of the price or are those considered something that's expensed?
It depends on what it is, and we're going to talk about those in a minute.
Okay.
It really depends, because if it's something that we're paying for registration fees and whatnot, it's going to affect the APIC part of a journal entry. If it's something that's like you're suggesting, an amount that's paid to an underwriter or something, then it's going to be expense. But we'll take a look at that here in a couple of seconds. Okay, good. Now, I do want you to use this mnemonic, and so I want you to go ahead and flashcard, and they're putting it in the form of a journal entry, but it's a fairly decent mnemonic, guys, and you know that I don't sit here generally and pay a whole lot of attention to some of these mnemonics, but in this case, I think it's worthwhile that the mnemonic, let me make that a capital N, is CAR in big. Okay, now they keep going back to this CAR in big as though, it's the panacea that's going to save you on all consolidation questions on the exam. And that's not true. Okay, this CAR in big would really save you if you were in a situation where you had a consolidation task-based simulation. In other words, they were asking you to do an entire simulation. Then you would go through and make sure you covered all the elements of the CAR in big. So the reason, journal entry, so the reason I'm having you flashcarded is in case you do get a task-based simulation. I don't see that it's particularly helpful for any one individual question. So even though they keep coming back to it and repeating it, if you're dealing with a multiple choice question where they're asking about an element of this, it's not that helpful. But if you get to a comprehensive question where they're asking you for the entire journal entry for a consolidation, then yeah, this would be good because you could go through the fact pattern of the problem and identify how to treat each one of these. Okay, good. Now you come over and you take a look. Again, obviously they fell in love with this mnemonic because they started drawing little pictures and everything else associated with it. Okay, now that's all not necessary. Okay, so what we're going to do is talk one at a time about these, and we're going to start with a big chunk of it, CAR, which is getting rid of the common stock, the APIC, and the retained earnings of the subsidiary on the date of acquisition. Now, for the common stock and the APIC, it's generally the same as whatever it was on the date of acquisition. Generally, in CPA exam questions, there isn't a contemplation of the subsidiary issuing additional stock after the acquisition. Therefore, the capital stock, the common stock, and the additional paid in capital will be exactly what it was on the day of acquisition. Retained earnings, of course, of the subsidiary will move. And the way we calculate retained earnings is what? Beginning balance in the retained earnings plus any net income minus any dividends gives us the ending balance. And if you're not remembering what they're trying to tell you there, that's base. Okay, now it is worth noting that on some CPA exam questions, what they like to do is give you the ending balance of the subsidiary's retained earnings. And you know that what? I need to sit there and I need to eliminate anything that was in the stockholders' equity at the date of acquisition. And in order to do that, I need to what? I need to know what the beginning retained earnings was when I do this elimination. So it is worthwhile to note that you may have to use base to work backwards to whatever the beginning balance was, and that would be the R for CAR in the elimination that you would make at the acquisition date, if that's what the question was expecting. And you need to always eliminate whatever was in the stockholders' equity at the date of the acquisition out of the subsidiary stockholders' equity. You eliminate the entire stockholders' equity. Okay. All right, good. That gets us through CAR. Let's take a look at the investment. Okay. Now, to your question, Kat, the original carrying amount of the investment of this in the subsidiary account on the parent's book is original cost measured by fair value. Again, at the date of the acquisition, when the deal is completed, we debit the investment for that. Now, let's take a look at business combination costs. Direct out-of-pocket cost and indirect cost are expense. So the answer to your question, I think, is yes, the way you framed it, that it would be for, underwriters and that their chunk is an expense. Okay. Now, we may also have to pay some sort of registration fees to the state, whatever, SEC filing fees. Those come out of the additional paid-in capital. The best way to handle this, guys, is to flashcard that. Okay, you just got to remember that. You just got to remember direct out-of-pocket costs that are paid are expensed. Any registration fees or SEC filings come out of the additional paid-in capital associated with that. Now, when we talk about SEC filing fees, stock registration, we're assuming there that the parent is not acquiring the investment for cash. They're acquiring that, they're issuing additional stock in order to acquire that particular subsidiary. So they're giving stock to the old stockholders to get rid of them. They're giving stock of their company, and there could be some fees associated with that. That comes out of APIC. Okay, so you come over and let's just take a look at this example, and you'll see that it's not that difficult. Okay, once you kind of look at a set of facts, the hard part is just remembering what to do with what they give you. Okay, so big company, and that's why I had to make that flashcard, exchange 10,000 shares of $10 par value common stock with a fair value of $415 for 100% of the outstanding stock of the subsidiary. I guess it's called what? Sub company, in a business combination properly accounted for as an acquisition. In addition, big company paid $35,000 of legal fees at the date of the acquisition. The fair value and book value of the subs net assets totaled $300,000, and we have registration fees of $420. So since our common stock had a fair value of 14, that's essentially what we're giving up fair value for the investment. Okay, so we debit the investment account for that. We're going to issue the common stock at par. Okay, and now we just need to take as legal expense the $35,000 that was the legal expense there. Now, if you had just simply done what? If you had just simply done the 415 minus the 100,000, we would have credited the APIC for a full 315. But since we had to pay those 20,000 of registration fees, we take that off, and we then would credit the APIC for the difference. And of course, we have to credit the cash for whatever we had to pay. Okay.
So the APIC number is just pretty much a plug.
You could look at it that way if you want to. I mean, I can explain to you where they got the number. So if you wanted to try to number this journal entry, Don, I would say the easiest way to do this is to first do this. Then I'd issue the common stock. Then I would credit the cash. Maybe I could do that first or second or third. Okay. Then I would do the expense. And then, yeah, I would say that the fifth line of the journal entry to figure out here is the additional paid-in capital. But I guess if you're asked a question where they're not asking you for the entire journal entry and they're just asking you for the APIC part of it, I'd hate to see you have to make an entire journal entry just to answer that part of the question when you can understand it from what's right there in that green down there.
Got it. Thank you.
Yeah. But if you were asked to make an entire journal entry, that's, I want to keep emphasizing, guys, for the CPA exam, You know, I recommend making journal entries from easiest line of the journal entry, finishing with the hardest. So if you have to plug, that you can. Okay. All right, good. And I'm not going to show you the same journal entry in the car. I'm big. That's not necessary. Okay. All right, good. Now you take a look, and you could have a situation in which there is contingent consideration. Okay. So when we have contingent consideration, now we have the situation where there is an obligation of the parent to transfer additional assets. Should get rid of this whole thing, but it doesn't let me. To transfer additional assets or equity interest to the former shareholders if specific conditions are met. So when that's the case, then we're going to contingent consideration is recorded by the parent on the acquisition date, adding estimates of the probable settlement cost and crediting a liability. Okay, so go ahead and flashcard that. And let's just look at this example, guys. And you're going to see again, not very difficult, but let's just take a look. On January 1st, year one, big company exchange, 10,000 shares of $10 par value common stock for a value of $4.15 for the 100% of the common stock of the subsidiary. In addition to the common stock, Big agreed to pay an additional $85,000 on January 1st, year 5, if the sub's average income for years 1 through 4 exceeds $50,000. On the acquisition date, Big believes that there'll be a 50% probability that the sub will achieve that, and then the fair value and book value of the net assets are $300,000. Okay, so now all we do is we go ahead and we add that additional estimate, that additional consideration to the cost of the investment. So that's $42,415 plus the $42,000 gets us up to this $457,500. Again, we go ahead and credit the common stock at par. You credit the APIC for the full $315, because in this example now we're assuming there are no acquisition cost at all. And then you go ahead and credit a liability for the $42,500. Now you come over and you take a look, and if there are changes, okay, then you just go ahead and book those changes. And I'm not going to get into the details here, guys, because apparently we thought that what we had put in initially wasn't enough. So we go ahead and we debit an expense for that increase and credit the liability for that additional amount. So maybe it's worthwhile by adjustment included in earnings, so that you realize that that is an expense as that investment changes, as that estimate changes. Okay. Okay, good. Come over, and when the parent is accounting for the investment on their books, they could use, and they're calling this the cost method, okay, which means there'll be no change in the investment after the acquisition date, okay, and dividends received by the parent would be treated as dividend income. The cost method, it would only be used for internal reporting purposes by the parent. The parent, for their external reporting purposes, should account for the investment under the equity method. Okay, so if you have a question that they're asking you to do a consolidation, and it's probably a full-blown consolidation, a test-based simulation, and they told you that they were accounting for the investment under the equity method, you would do the eliminating entry just as you would at the date of the acquisition, credit the investment, get rid of the entire common stock of the subsidiary at that point in time. And then any dividends received, you would have to credit dividend, and you would debit whatever the investment income was that the parent reported for their earnings from dividends that were paid for them. Hopefully the exams will ask you more of the equity method, Because under the equity method, which is what we're going to study here, we're going to see that you have to consider the changes to the investment account under the equity method to figure out what it is that you would eliminate at the end of the year out of the investment account. Because remember, for the investment account, we have the beginning balance of the investment plus the net income minus any dividends give us the ending balance of the investment account. And you would have to go through that process to figure out what the elimination is in the investment account. So we typically, in most questions that we're looking at, are contemplating that the entity is using the equity method. Okay, but just to make sure that we're recalling what we have said about the equity method, whatever the initial investment was plus the net income minus the dividend, meaning when we go to do the elimination of the investment account, we wouldn't eliminate 2.5, assuming the parent was using the equity method for internal purposes. We would have to credit 2.7 to the investment account.
Question. If a company bought 100% of a subsidiary, might they still be using the equity method to account for that subsidiary internally? Is that the point of this?
Well, yeah, they absolutely would. For their books, for their purposes, they would should be using the equity method for anything they prepare in financial statements. But if I guess that's all internal, they're saying to us they could be using the cost method because it doesn't matter if nobody ever sees external financial reports. So you really need to read the question to see if they're telling you they're using the cost method to account for the investment, then the amount that you would eliminate, if you looked at this example, would be 2.5, but you'd also have to eliminate any dividend earnings that they had considered. They're essentially using fair value through net income method, right? Where our income is the dividend, even though they're calling it the cost method. But if we are using the equity method, then you're going to have to go through this process to know what it is that you would eliminate. So you're asking me a question as though there's a consistent way that everybody does it, and it just depends.
I think I was just confused about the terminology because up until this paragraph, equity method to me meant they had bought between 20 and 50% of the company. And we were speaking about an external reporting paradigm. And it sounds like here we're going to the internal reporting paradigm. And it could be either, even if they bought 100%. So I'm just trying to get myself unconfused about the terminology.
Well, let me ask you this. If the investee paid a dividend in the situation that you're describing, how would you expect the parent to account for that?
I think I wouldn't know. I'd have to call you and ask.
Right, and I guess what I'm saying, thank you. I guess what I'm saying here is there's two options.
Okay.
They could, right, if they say, well, look, this is only for external reporting. I mean, we're not going to prepare a set of external reports.
Right.
So it's easy enough for us to debit cash, say the dividend was, $1,000, whatever, and credit the investment income.
Okay.
Because they can't just ignore the transaction, right? So they go with this kind of low-hanging fruit thing here, and they just do this for their internal purposes. When you consolidate, okay, you would have to eliminate that investment income. So you
right, it would be intercompany, right? It'd be an intercompany transfer of some kind.
Right. So you would have to debit the investment income account to get rid of that. And you don't have to make an adjustment to cash there because you're going to consolidate the cash in, cash out. I'm thinking the eliminating entry there would be to credit the dividend on the subsidiary's books, because the subsidiary would have debited dividend 1,000 and credited cash, right?
Mm-hmm.
On their books.
Yeah.
Okay. And so to eliminate this, we would debit investment 1,000 and credit the dividend, right?
Right.
1,000, but all that is assuming that the parent is using the cost method for these internal purposes, right?
Right.
But I'm saying, I don't know. I'm thinking the parent may want to have a look at what the external reports would look like of just the parent. And if that's the case, then they're probably using the equity method. And if that's the case, what they would have done was taken their share of the income of the subsidiary into the investment account and then reduced it by the dividend, right?
Mhm.
So all we're saying here, because remember, we're talking about one line at a time here, for the investment account, the credit to investment would then have to be this 2.7.
Okay.
And I don't want to do the whole rest
No,
of
that's
it.
okay.
I don't know exactly what, but you would go through that whole process now, to get rid of the other elements in a full-blown consolidation. Okay. Okay, good. Let's go ahead and let's take a look at this first question. And let's see. Okay, today my main computer is the main computer. So let's go ahead and put up our first question. Okay, good. Let's go ahead and take a look at this one. Looks like everyone's had a chance to try it. So I'm going to end the poll. And good. Looks like most of us got it right here. At least, well, 60% of us got it right. That probably should be a little higher, actually, for this particular question. And basically, everything, guys, is brought on at fair value. We bring everything at fair value. Nothing comes in at book value. We bring everything in at fair value. So if we're sitting there and we think that the assets, in my little example, let's say we thought that there was a $10,000 difference between the fair value of the equipment that was on the books of the parent, on the books of the subsidiary, and our fair value, the fair value that we acquired. Just going back to that little example real quick. Where are you now? Did I close it really? I guess I did. Let's see, but it may not be that hard to find. Surely you joke, John, that something would be hard to find. Okay. So let's say in this little example, I thought that the equipment, instead of being worth the 50,000, let's say I thought it was worth 60,000. Well, then that consolidating entry would have to be what? 10,000 that I'm adding. And again, I forgot to put my equipment on the parents' books. right? And so I would have to, I'm going to just show you down here in the consolidating journal entry, I would have to debit equipment for 10,000 to bring it up to that higher fair value. I credit the investment for $1 million, and now my goodwill becomes what, 940? Okay, so you bring everything up to fair value. You're essentially saying that old company, that's over with. And we're starting a whole new thing now using the fair value of the new company. So everything comes in at fair value. Okay. Question? Okay, good. Let's go ahead and let's take a look at this one. Okay, looks like just about everyone's had a chance to take a look at that one. So I'm going to go ahead and end the poll and share the results. Okay, again, 60% of us got this one right. Same number we had for the first one. Okay, and guys, I'm looking at this question and I'm thinking that's not terribly difficult because we talked it pretty clearly that we expense what fees of findings and consultants, and then registration fees reduce the APIC, right? So the answer here is B. They're not expense, they reduce the APIC. Look, guys, I'm going to have a little talk with you here. If you plan to pass the CPA exam, you're going to learn this stuff sooner or later. I mean, if there's some kind of idea that, you know, you're gaining something by not trying and just kind of, you know, pressing a button here and watching TV while you're reviewing the course or something, you're just part, you know, showing your name up, I suggest you drop the class. I mean, just get out now. There's no sense in wasting valuable time. Life is too short to just sit here and kind of, you know, pretend like you're taking the class to get a grade in the class. It's not worth it. It's really not. Okay. Okay. So unless there was a specific question here, something that I'm missing, it seemed like we should have been well over the 60% threshold there to get to on this one. Okay. Okay, good. So let's just go ahead then and let's move on to the next discussion. Okay. And let's take a look now. And again, we are going through the elements of CAR in big. Okay, so now we're going to go ahead and deal with the non-controlling interest. Okay, and let's just go ahead and take a look at the non-controlling interest. And, you know, at acquisition date, we will basically figure out the non-controlling interest by taking the fair value of the subsidiary times the non-controlling interest percentage. And that gives us the amount that is the non-controlling interest. Now, they slap that there, and that's a little annoying because the process is a little more involved than that, because you've got to sort of figure out the fair value of the subsidiary in some of these questions. And so they act like, oh, well, you just take the fair value of the subsidiary, like someone's going to give you all that information. So we'll see how that works in a minute. But the consolidated balance sheet, we show 100% of the subsidiary's assets and liabilities. The non-controlling interest share of the subsidiary's net assets should be presented on the balance sheet as part of stockholders' equity, separately from the equity of the parent company. Okay, so go ahead and flashcard that, but I want you to go ahead and put C page and just go ahead and put C page 67 here. See page 67, but just to make sure we got a visual on this, let's just jump ourselves to page 67 if we can. Not too much consternation here. Okay, good. Let me do it. Thank you, God. Okay, and you come over and they give us an example of a consolidated balance sheet, right? Okay, now when you look at this consolidated balance sheet, it's 100% of the assets, liabilities. We don't back out the non-controlling interest of those pieces. What we do is we come over and we do what? We bring in that non-controlling interest portion down there at the bottom of the stockholders' equity to show what portion of everything, the 100% of the company, is attributable to the non-controlling interest. Okay, now, of course, the non-controlling interest will change from the date of the acquisition. So I just want to go back to page, what were we on? Page, somebody help me out, 47?
47, yeah.
Okay, okay, great. So you come over and let's just take a look at how we will deal with the non-controlling interest after the acquisition date. And I want you to flashcard that. But I also want you to realize that this is like L-I-K-E, the retained earnings of the non-controlling interest, NCI, non-controlling interest. Look at that. It's the beginning balance, whatever it was at the date of acquisition, plus the non-controlling interest share of the subsidiary's net income. If the non-controlling interest has a 25% share, we take whatever the net income is of the subsidiary, multiply that by 25%. That's the part that goes to the non-controlling interest, minus the non-controlling interest share of the dividends. So if there was a $10,000 dividend paid out, 10,000 times 25% is minus 2,500, gives you what the ending amount of the non-controlling interest should be. And that would have to be brought onto the books now at the end of the year on that amount.
Question, does it matter how large the non-controlling interest is? I mean, obviously it would be less than 50% because you wouldn't be consolidating and having a non-controlling interest if the non-controlling interest was larger than 50%. But I mean, does it matter if it's a 5%, for example, interest in the company, which would the non-controlling interest accounting books would show as a fair value investment? You see what I'm saying? I'm saying you would account, if you're the acquirer, even if it was only a 5% interest, you would still compute the non-controlling interest using the equity method, even though their books, they were doing it differently, right?
I'm having trouble. You're talking about shareholders who hold, say, 5% of the stock.
Yeah, if the non-controlling interest, say, was 5%, so you would, but you're the majority owner and you're consolidating, you would still use the equity method to compute their interest, even though they have less than 20%.
No, I mean, if we're doing the accounting, I think what you're asking me is the accounting for the non-controlling interest, and they would be using the fair value through net income.
Right, yeah, that's what I meant. But if you're the controlling party, you are the controlling interest, you would be accounting for their interest as if it was the equity method. That's what I'm trying to say. I'm confused about the word equity method is used in a bunch of different contexts, and I'm trying to get it untangled.
Okay, fine. I'm not doing the accounting for the non-controlling interest. If I'm the parent, I'm doing the accounting for my own portion
Yeah.
of the investment.
Okay,
So I don't care what they're doing. I mean, I assume they're using fair value through net income method. I'm using the equity method. They do what they do. I do what I do. All I'm doing at this point is bringing on their share of the stockholders' equity. And I would need to, adjust that number that I bring on would have to be adjusted for their share of the income, their share of any dividends, right?
okay,
So
Okay,
if
I
you look
get
at
it.
that, that's basically a statement of retained earnings.
okay.
Yeah.
All right, thank you.
Yeah. Okay, good. So we come over and let's look at the income statement. Okay, now this is an easy mistake to make on CPA exam questions because you're in a hurry and your instinct is, oh, well, we only take the controlling interest share of the revenues. We only take the controlling interest share of the expense. You need to purge that from your mind right now. You take 100% of the revenue, 100% of the expenses, all of that is going to show in total on the consolidated income statement. Okay, so that's 100%. Okay, now it's important to note though that it is after the date of acquisition. Okay, and we're going to talk about that here in a second. I'm going to show you an example of a question in a second. Okay. The consolidated income statement should not show net income attributable to non-controlling interest separately from net income attributed to the parent. 100% of the revenue, 100% of the expenses, 100% of the net income. Okay, now we will then though have to compute the non-controlling interest share of the net income. And guys, that's a piece of cake. Subsidiary is 100% net income, right? 100%. I just want to emphasize that. 100%, 100% of the expenses, right? That gives me what? 100% of the net income. And then I multiply that times the non-controlling interest share, and that becomes the share of the net income that is what? Belonging to the non-controlling interest. And here, if you don't want to let me put a box around that there, okay? So there's my percent of the non-controlling interest. And I will show that on the income statement as a subtract from the overall net income. So go ahead and put down, put that flashcard this, okay? And the consolidated income statement should show net income attributed to non-controlling interest separately. For that statement, put in flashcard that, and then put C page, and let's look at page 68 this time. Okay, so you come over to page 68. Okay, is that my page 68? Yeah. Okay, and it's pretty easy, guys. After you do that little multiplication, 100% of the revenue, 100% of the expense, net income of the subsidiary, and then you multiply that net income number, the 100% net income number, by the controlling interest share, and you show that as a subtract at the bottom of the income statement. And then what you're reporting is the net income that's left to the majority shareholders of the subsidiary. Okay. Okay, good. I can go back now to, someone help me out again. What page? 58? What page is that?
48.
48. Wishful thinking that I'm on 58. Right? Okay. Okay, good. Okay, good. Now, the other thing I want to do, though, is make sure you flashcard this notion that it is after the acquisition date. And what I want to do is ask you to see MQC, multiple choice question, 00421. Multiple choice question 00421, 00421. And if I am recalling correctly, that question appears as one of our class questions, but I forgot for my own personal notes here to write down what page that's on. Does anybody see that one?
It's not in this unit, it doesn't look like.
No?
Mm-mm.
Okay.
It's on page 77. Okay, so maybe I'm wrong.
Page 77.
Is
It's
it
at the end,
77?
Module 7.
Okay, sorry guys. So let's just do that. Let's jump. Thank you. Let's just jump to page 77 because there's kind of a disconnect between when they're telling us that and when they give us some helpful, what the hell does that mean kind of a experience. So thank you. So it's on page, and you might want to note when I go back to that page, I'll write it in there next to where once you make the flashcard. But for now, let's just look at it right here. So if you can flip to page 77, and let's just do this together. Okay, so what happens on October 1st, or excuse me, September 1st, we have this Philip issued common stock in exchange for 20% of Sago Inc.'s outstanding common stock. On July 1st, year 3, Phillips issued stock for an additional 75% of Sago's outstanding common stock. Sago continues in existence as Phillips subsidiary. How much of Sago's 3-year net income should be reported as accruing to Phillips? And so what happens? 20% of Sago's net income to June 30 and all of Sago's net income from July? Well, no, because we never got to 100%, right? It was 20 plus 75. 20% to June 30th, and then what? 95% from July 1st to December 31st. Yes, we only take what? The income pieces attributable to what we had at that time. Okay. Okay, good. So come back. And
48, I think.
Say it again.
I think it was 48 or 49.
48. Thank you. And now someone's going to have to remind me. What page were we on there? 77 before? Okay.
77, yeah.
77.
So you can even put in there C just to help you figure out where that was. See page 77. Okay, good. All right. Now you come over and let's take a look now at how to compute the non-controlling interest. And you're going to sort of see here why I got a little annoyed with that little thing that they slapped down there, because they don't kind of give you the full story here. Okay, because if the question told you that Garrity acquires 60%, and maybe this is so obvious, that's why they didn't say it, but to me, it's not that obvious. If they tell you that Garrity acquired 60% of Foxy Inc. for $69,000, then to figure out the fair value of Foxy, right, we've got to sit here and say, well, 69 million divided by what? Divided by 0.6 means that what? Means that Foxy is worth 115 million, right? So I don't know, maybe you saw that already, but to me, I think it's worth calling that out. And then once you get that number, then you can go ahead and, well, if I'm buying 60%, the non-controlling interest is 40%, 40% of 115 is 46,000. So, they tell you, well, just multiply the non-controlling interest by the fair value of the sub, but what if they don't tell me the fair value of the sub and they make me go through this maneuver to get it? Okay. Okay, good. Now, notice here, they tell me that, let's just look at the rest of this just so we kind of can understand the journal entry, the acquisition date journal entry. We have what? We have goodwill. Well, we have the net assets are 80,000. Okay. The fair value are 100,000. And then we have what? We have fair value of 115. Okay. Now, important thing to realize, when you get to the point where you are acquiring less than 100% of the stock of the company, you bring on the goodwill for the full goodwill, the difference between the fair value of the assets and the full fair value of the company. And you have to do this because you're saying, hey, some of this goodwill belongs to the non-controlling interest. So when you're acquiring 100% of the stock, it's very simple. It's like what we were doing when I was telling you before. What did you pay? What did you get at fair value? What did I pay? What did I get? Difference is goodwill. But if you're sitting there and you're not acquiring 100% of the stock, then you're going to have to figure out the fair value of the company, and you may have to do this, right? And not only would that allow you to then calculate the fair value of the company, but then any difference between the entire fair value of the company and the fair value of the identifiable assets, difference becomes goodwill. So when you look at this question, then I think you're hopefully understanding that the goodwill would be what? The goodwill would be 15 million in this case, because the fair value of all the assets are 100,000, the entire fair value, not just the controlling interest portion, the entire fair value of the company is 115 million. Okay, we would have to write up the assets, just like I showed you writing up that 10,000. You always get rid of the book value of the company at the date of acquisition. Book value is, assets minus liabilities. In other words, the CAR, the stockholders' equity of the subsidiary, gets eliminated entirely. You eliminate the entire investment account. You bring on the non-controlling interest. Okay. Okay, good. Now, they're going to talk, we've talked about adjusting the assets to fair value, but it turns out that there is a pecking order to how you assign the acquisition price to the fair value. Okay, so let's just go ahead and let's just take a look at how that pecking order will work. And you first adjust any items on the balance sheet for assets and liabilities to fair value. That's tangible assets and liabilities. Then you would assign any remaining acquisition price to bring the intangible assets to fair value. And this whole thing is a flashcard. And then if there's anything left over, then you'll do what? Then you will go for the difference to goodwill. Okay, so they're basically telling us that same thing here in these steps. Okay, step 1, step 2, but let's just look a little closer at step 2 and remind ourselves of identifiable intangible assets, for example, patents. Okay, but notice something interesting here. In process research and development. So we could assign some of our fair value to in-process research and development. Now, you got to kind of look at it 2 different ways. The entity that's been conducting the research and development, what have they been doing with those costs all this time? They spend money on research and development. What have they been doing with it?
Expensing it.
Good. They've been expensing it. So there is no asset on the books for the research and development. Now I come along and I acquire the company. And in many cases, the reason I'm acquiring the company is for the research and development that they've got going on, because I think it's going to work out, right? So what happens? I would have to then look at what I believe to be the fair value of that research and development that's in progress, and I would have to assign some of the acquisition price to that. Okay. Now you take a look and let's see what we do if we do that in process research and development, and let's flashcard this. Okay. And we say, hey, you recognize the intangible asset separately from goodwill. We'll have to value that. We do not write it off unless what? Unless it becomes infeasible that it's not going to work, then you would write it off, right? So I buy the research and development and I'm unlucky and it doesn't work out, then I have to write it off, right? But I would bring it on as an asset at the acquisition date. Okay. Now, if it is some sort of intangible that has a research and development that has a finite life, then I would amortize it. Okay. If it has an indefinite life, then I will, and we're going to look at impairment for goodwill here a little bit later, but you would evaluate for impairment and you would have to do that by reporting unit. And we're going to look at that a little bit later. Now, what should I do as I continue to spend money on the research and development? So I bought the research and development, was in progress, and then I turn around and I continue to spend money to keep that research and development going now as the parent. What should I do?
Expense it.
Good. Going forward, very good. On going forward, I do what? I expense any money I spend on it. So I can bring the intangible on the books at the acquisition date. I'll amortize that, but any money that I continue to spend on that gets expensed. Okay. And again, we outlined the steps before. Any remaining amount of the acquisition cost would be goodwill. Okay. Okay, good. Let's just take a look again at another example. And I kind of debated with myself earlier today, does it make any sense to go through a second example of this? It's very similar to what we talked about before, but let's just go ahead and let's take the time to look at that since this is here. Okay. So what happens? I'm going to purchase 60% of this company, okay, for 75,000 cash, okay. And then they tell me that the fair value of Garrity is 125. And so they got that by what? By taking the 75,000 or 75 million and dividing that by what? 0.6. Divide that by 0.6. That's where they got the 125 million. Okay, maybe that's just so obvious to you, you don't need me to tell you that. And then if we want to get the non-controlling interest, we multiply that by what? By 0.4. And that gives us the, I don't have to redo that. That's right there. That gives me the non-controlling interest of 50 million, right? Okay. Now the goodwill is what? The 125 million, the entire fair value of the company. Okay. And they tell us that the fair value of their net identifiable assets is 60 million. So the difference is what? 65 million. That's the goodwill. So now I realize there's absolutely no point in going through this example, okay? Because it's the same damn thing we did a minute ago. So note to self, John, don't waste time next time going through a repetitive example like this. Maybe it's good to have a second shot at this. Question? Okay, so there's not a very good connection between what we were just talking about in that example. Okay, but let's just go ahead and let's talk about acquisition with a gain. Okay, now what's going to happen here? For some strange reason, we are going to be able to acquire the fair value of the assets, the net assets of this company for less than their fair value. I don't think it happens very often. You know, when I'm sitting here and I was trying to think of, well, how would this happen? I'm thinking there was a plane crash and nobody wants to buy the planes now. So we get a deal on the planes. I can only think of a tragic example where a company would be able to sell, would only be able to sell assets that have fair value for less than their fair value. Okay.
I've got
But
an
if-
example, actually. I've seen one. There was a company that got a really cheap valuation from a really bad firm before they sold, and we figured that when they came to us for their parent came to us for the purchase price allocation, and we determined that they probably left about $1 million on the table when they sold their company because they had bad advice. And so that would be a circumstance where you end up with this situation.
Okay. Well, I just, you know, I've had a trouble digesting that a little bit, but if you say so, but I guess,
No, they negotiated badly. Let's just say they negotiated badly when they sold their company. So the parent got an acquisition with the gain because the new parent basically had identifiable assets that were worth more than what they paid for the company.
okay. Well, again, I'm not quite understanding that, but anyway, if that's the case, adjust the assets to fair value. You're going to adjust any identifiable assets to fair value, and that difference between what you paid and the fair value of everything is seen as a gain. Okay. There was a time before FASB got rid of extraordinary items that they made you, you know, treat that as an extraordinary item because it's like, what's going on? I mean, why would, you know, I don't think we contemplate bad business decisions, you know, generally. So anyway, but let's just go ahead. We purchase 100 million for $1 million. The net book value is 800,000. Fair value is 1.2. So somehow Garrity was able to figure out how to spend 1 million for stuff that had a fair value of 1.2. Never happens to me. But what happens, we sit here and notice that now instead of debiting goodwill, we credit a gain on the transaction. Nice work if you can get it, I guess. Okay. Okay, good. Let's go past the measurement period adjustments, guys. If there's a change in the values, you just book the changes. Okay, I think they wanted to squeeze in there some more material that I don't see the real point to a lot of that. Okay, so let's just go ahead and I'll tell you what, good. Let's work these couple questions and then we'll take a break. Okay.
Is there a poll?
Oh, sorry. There will be in 2 seconds. Okay, guys, I'm gonna give you a couple more seconds, then we're gonna end this, so make your best shot here. Okay. Okay, good. And yeah, pretty good response for this one. Questions got a little bit of work to it, so let's just go ahead and let's take a look at it. And on September 29th, year one, Wall Company paid $860 for all the issued and outstanding common shares of Hart Corp. So what happens? 100% acquisition, right? If it's 100% acquisition, then it's just like we were talking about the other day when I was talking about how to calculate the, and again, we don't report that goodwill, but the goodwill that's attributed to the transaction is what did you pay? What did you get? When it's 100%, that's all you have to do. So you paid what? You paid $860 and you got fair value of what? Now it's the fair value of the net assets. Net assets is what? Are assets minus liabilities. The liabilities, and we use fair value for everything, had a fair value of $840 for the assets. And what for the liabilities, it was $140. So we go ahead and we subtract off the $140. So we acquired what? Fair value of 700,000 here, right? Of the net assets. So 700,000 is what we got. We paid for $860 for that. So that difference is the goodwill. Question? What did you pay? What did you get? That's all you have to do if they're asking you the implied goodwill, the attributed goodwill for an equity method transaction when we're under the 50%. That's all you have to do when we are past the 50% and we're acquiring 100%. Obviously, if we're acquiring 100, we're past the 50. If you acquire what? An amount that's over the 50, but less than the 75, then you're going to have to take a different approach. And I'm going to go ahead and let you work with that one here. I'm not going to do it with you at this point because I think we've practiced this a couple times now that you should be comfortable attempting this on your own. Okay, looks like most of us have had a chance to attempt this one, so I'm going to go ahead. Anyone need more time? So let's just go ahead and take a look at this one. And oops, I don't want to relaunch the poll. I want to get this poll out of my way. Okay, now when you look at this one, they tell us, look, they paid 13 million for what? 75% interest. So when you fall below the 100%, and you know that you have to report goodwill because we're going to have a consolidated balance sheet here. So I have to take what? I have to take the 13 million. I divide it by what? 0.75. That gives me what?
Is it the 13 or the 12?
It's 12. Pay 12.
Oh, yeah, sorry. I have to take the 12 million, thank you. And I divide that by 0.75 and I get the 16 million. Thanks, guys. So I have this what? I have this 16 million and they tell me that what? The fair value of the net assets is what? Is 13 million. So since the fair value of the assets is 13 and they paid what? They paid 16, then we have 3 million of goodwill. So that's a little different in that now you're having to what? Consider the portion of the goodwill that belongs to the non-controlling interest, right? Okay. Now, when you look at this whole, sort of car in big journal entry, I'm going to go ahead and continue on. This question didn't ask this, but let's just go ahead and apply it to some things, other things we learned. 12 million times 0.25 obviously is what? 4 million. So I now know the non-controlling interest, don't I? Okay. So I can go ahead and if the book value of the assets were 11 million, then I'm going to go ahead and I'm just going to do my car in big entry here. My car would be a debit for 11 million because I always get rid of the stockholders' equity of the subsidiary at the date of the acquisition. I'm going to go ahead and write up the assets.
Professor, the 12 million multiplied 0.25 is 3 million.
I'm sorry?
12 million multiplied 0.25, it's 3 million. No.
Oh, sorry. Thank you. Yeah. Thank you. 3 million. Thank you. Which is the end. Huh? Wait a minute. We paid 12 million.
You want 16 for the NCI.
Thank you. Sorry. For the non-controlling interest, since the company is worth 16, thank you. 16 million, I have to take the 16 times the 0.25. That's where I got the 4 million. Right? The fair value of the company we calculated this way, because if you paid 12 for 0.75, then the whole company is worth 16. We got 75%. The non-controlling interest got 25%. So that's where I got the 4 million. Okay. Okay, good. I have to write up the assets. What? I have to write up the assets here, 2 million. Because their book value is what? Is 11, and they tell me they had fair value of 13. I have to go ahead and what? Credit the investment. Because I'm going to get rid of the investment. I'm going to credit that for the 12 million that I paid. Right? I have to bring on the non-controlling interest, which is 4 million. And then to make the journal entry balance, and I'm just going to sort of write it up here, I'd have to bring in the goodwill, and the goodwill is what? 3 million here. Okay, but you can see, even though I gave you the whole journal entry here, why I'm not too enamored with them showing us this car in big every single time, Because why would you want to sit there and do all this when you can just do the calculation, which most of us got right here? Okay. Question? Okay, good. So let's go ahead and let's take a break right now, and we will come back in about 10 minutes. So I'm just going to say that we will come back. Let's just make it an even 6:40. Okay. And I'm going to pause the recording, and Matthew's going to remind me to turn it back on. Thank you, Matthew. Thank you for volunteering. Back. And let's start to take a look now at our next discussion here, intercompany transactions. Okay. Now, the key word here is eliminate. Okay. We are not going to be able to report sales to a company that we control because we're really treating this as one company, right? We're not going to be putting down amounts that we owe to each other, because when we do the consolidation, we are simply essentially showing it as one company. So when there are intercompany transactions, okay, I think that sometimes students get scared of this, and I'm like, this is probably one of the easier things that we do on the exam, because you get to essentially get points on the exam if they ask you to do a full-blown consolidation by eliminating 100% of intercompany payables and receivables. So notice they do that. Okay. Now, if we are dealing with the income statement, okay, it gets a little bit more involved, but still not horribly difficult, I don't think. Okay, but I'm just going to ask you to make a flashcard right here. Okay, let's just make a flashcard here that I'm going to ask you to just basically write it. Okay, so for the income statement, eliminate, how do we spell eliminate? Sorry, guys. Eliminate 100% of intercompany sales. You're flashcarding this, right? Flashcard. Okay, eliminate 100% of intercompany sales. Okay, eliminate 100% of intercompany. Let's just go ahead and put it on this flashcard, even though we already said that, payables and receivables. Eliminate 100% of intercompanies, payables and receivables. Okay. Eliminate, I don't know if this keeps saying 100% of, and cost of goods sold from seller. Okay, think about this for a second. Eliminate 100% of cost of goods sold from seller. There is no cost of goods sold. You can't sell stuff to yourself, so there would be no cost of goods sold. So you eliminate 100% of cost of goods sold from the seller. Okay, and then we have the issue of the buyer, right? Now the buyer is going to do what? They sold those things to outsiders, didn't they? They actually sold those things to outsiders in some cases. So if that's the case, then eliminate intercompany profit from cost of goods sold of buyer. Now, again, this is assuming that whoever bought this inventory, right? Whoever bought this inventory sold it to an outsider, but they've got the profit margin sitting in their cost of goods sold. So we need to get rid of that. Now, if they don't sell all of the inventory that they bought in this intercompany transaction, and some of it is still sitting in ending inventory, then eliminate intercompany profit from EI's ending inventory of buyer. Because they're either have sold that stuff or it's still sitting in the inventory. Okay, so you eliminate the cost of goods sold, you eliminate the intercompany profit from the ending inventory. Okay, now flashcard that, and let's look at the example, and then we'll see if you have any questions about any of this. Okay, but let's just look at the example. Do you get this notes here, guys? You're good? Okay, so let's just look at the example over here. Okay, and let's just take a look at what happens when you have this intercompany transaction. And basically, well, I want to look at the example now because I gave you a flashcard on that, so we don't need to read through that. I think now we're ready for the example. So just come over to the example, and Garrity Corporation owns 100% of the common stock of Olento Corporation. Garrity sold inventory with a cost of $1 million to Olento for 1.1 million. So there's a profit there of what, 100,000 that we're going to have to deal with. The ending inventory of Olento includes purchases, goods purchased from Garrity of 660. So they didn't sell everything, right? They sold only a portion of it. And Olento has a remaining accounts payable balance of 200,000. And they want us to go ahead and make the eliminating journal entries here. Now, before, they just show us to help us to kind of follow what happened. There was the sale, the account receivable on Garrity's books. This is not the eliminating entry. This is what Garrity did. They went ahead and they debited the cost of goods sold. They credited the inventory. And on Olento's books, they went ahead and debited the inventory for what they bought it for from their parent, from the affiliated entity, for 1.1 million and set up the payable. Now, if I'm looking at the CPA exam, let's just start with the easiest thing in the world. They told me there's 200,000 that's left. I have to eliminate 100% of the intercompany payable and receivable. That's a piece of cake. Okay. My flashcard to you said what? Eliminate 100% of the intercompany sale. So we have to debit the sales for the entire amount. My flashcard to you said, do what? Eliminate 100% of the cost of goods sold on the books of the seller. Is that what we did? Okay, so now we're only left with what to do with the buyer. Now, the only thing that gets a little tricky here is we have to figure out either the cost complement or the gross profit complement here. And so what happens? If we have, and I'm going to do the cost complement, guys, if we have what? Sales of 1,100,000, okay? And they're sitting there and they're telling me that what? That 660 of that was in the cost of goods sold. They sold outsiders 660. Or I'm sorry, they told me that the inventory was what? 660. That means that what? 60% of whatever the intercompany profit is left in ending inventory, and 40% must be attributable to what? Therefore, the cost of goods sold. Okay, they tell me that 660 is left in the inventory, right? And there were sales of 1,100,000, then they're telling me that 60% of the stuff is still sitting in the inventory and 40% is in the cost of goods sold, right? Okay, still included in inventory. So if that's the case, then I can take that 100,000 intercompany profit, right? The cost was $1 million, the sales price was 100,000, and 60% of that got to come out of the inventory, and the remaining what? 40% has to come out of the cost of goods sold. Question? Now, you get on the CPA exam and you have a, full-blown question that asks you about, intercompany transactions like this. There's going to be a lot of easy points for you there. Important point about consolidation question, common mistake that is made by students. They try to get it perfect. The examiners are going to try to get you to waste a bunch of time on nitty-gritty points that you're not going to be able to get. Don't worry about it. Get as many of these easy things that you can so you can get what? As many points as possible. And I'm looking at a consolidation. I hope you get one, because there are so many easy points that you can pick up as you go along, even if you don't nail the consolidation 100%. Okay. Okay, good. Now let's go over and let's just look at a couple more items that you might see. Okay, and again, this starts to get more into a full-blown consolidation, task-based simulation type of thing. Okay, but let's say we issue bonds to an affiliate, okay, and we issue those bonds at a premium of 50,000. Now, the entity that issued the bonds will get the cash and they get this $50,000 premium. The purchaser paid what? Paid this 275 for this, and they have this investment. Okay, now think about it for a second. Let's say you sold bonds and you got 300,000 cash, and then you turned around and someone said, well, you know what? You can pay that bond off for 275. Well, if that's the case, I'm going to get to remove what? I'm going to get to remove the bond payable 250 and the premium of 50,000. So I'm getting to remove liability of what? 300,000. And really all I had to do was what? Was give up 275 cash to get rid of that. That's considered a gain, isn't it? Okay, now look, I don't know, how a transaction like this would actually happen, because whoever it is that ultimately bought these bonds would be, getting screwed in this deal. But they're just saying that whatever it is you would be taking off the books, if you're taking off what? If you're taking off an amount that is the liability that is greater than whatever cash you got, that's a gain. Okay. Okay, good. Now you come over and intercompany interest is eliminated. Amortization of discount or premium is going to be eliminated when we have intercompany bond transactions. Intercompany sale of land. Okay, and with the intercompany sale of land, we're going to have to eliminate any gain or loss and adjust the land back to its original cost. So you can flashcard that, but if you take a look here, they bought some land that had a for 200,000 and it had a book value of 175. So the seller here booked a gain of 25. The buyer debited the land and credited the cash. You can't sell land to yourself, right? Because we're again considering consolidation as one company. So what you will do is you will simply bring the land back to its original cost by creating the land and eliminating that gain. Now, in subsequent periods, note that that debit would go to what? Would go to retained earnings, because eventually when we do our closing entries, we're going to close that gain to retained earnings. So going forward, we have to debit retained earnings to get rid of that gain. And we always credit the land to bring it back to its original cost. Now, when we're dealing with depreciable assets, that process is going to be a little different because we're going to be depreciating the asset on the books of the buyer at whatever their cost was. Meanwhile, as a consolidated company, we need to be depreciating that equipment, depreciable asset, whatever, at the original cost. And so it gets a little bit more involved, but let's just go ahead and take a look than what we saw for the land. We have land, and let's just look at the facts. Sold equipment to Garrity for $100,000. The equipment had a book value of 70, cost of 90, accumulated depreciation of 20, and it has a remaining useful life of 10 years. Okay. Now, for the seller, they debit cash. They're getting rid of the equipment, so they debit the accumulated depreciation on that. They credit the machinery for that. And I don't know, they got a little sloppy with their dollar signs. I don't know why that bothers me, but then you go ahead and you credit the gain on the book of the seller. Okay. Then for the buyer, you bring the machine on now at what they paid for it. Now the buyer, Garrity in this case, is going to depreciate that asset at the cost. Okay. Now, when we go to do the eliminating entry, we're going to, let's just do this, the easy stuff first. We're going to credit the machinery for 10,000. So now it's back at the original cost of 90,000, isn't it? Okay. We credit the accumulated depreciation for 20,000 to put back that accumulated depreciation that we took out, and we eliminate the intercompany gain. Now that's in the year of sale, right? The other thing we have to do is we have to go ahead and adjust the depreciation, excuse me, because who sold it? Olinto. Olinto, should have depreciated it at the remaining period for 10 years at its book value 70 for 7,000. The Garrity depreciated it at 10,000, right? So to fix that, to bring the depreciation based on whatever its book value was at the time of the sale, we have to go ahead and debit the accumulated depreciation, credit the depreciation expense for 3,000. That brings everything back on a consolidated basis as though there was never a sale, right? Now, where it gets interesting is what happens in subsequent years, okay? After the year of acquisition. All that was the year of acquisition. In the subsequent year, the intercompany gain or loss and the excess depreciation have been closed out to retain earnings. So the eliminating entry in subsequent years, therefore, adjust retained earnings, okay? So what happens? Think about it for a second. We have what? In the retained earnings, we have that intercompany gain sitting there at 30,000, don't we? And then we have what? And then we have the accumulated depreciation, and the accumulated depreciation is sitting there, and the accumulated depreciation has a debit of 20,000. Now we've got excess depreciation of what? Of $3,000 every year. And so to remove that excess depreciation going forward, to get the correct balance in the retained earnings, we will simply do what? We will simply debit the retained earnings for 27,000. When we do, we have what? Taken out the intercompany gain, but we don't want to take it all out because we have to put back some of that extra depreciation expense, right? And in the what? In the accumulated depreciation, we have the 3,000, but since we want to what? Debit the accumulated depreciation net of 3,000, we go ahead and credit it. That gives me my what? My debit to accumulated depreciation here of 3,000 that's left. And then I go ahead and I simply credit the machinery for 10,000. And then, of course, I have to adjust the accumulated depreciation expense for year 2. So I'd have to do this every year, and then in subsequent years, I would keep on reducing the amount that I have to credit and debit to the retained earnings by the excess depreciation that would be sitting in there already. Okay. Okay, good. Let's look at this question here. Okay, guys, let's go ahead and take a look at this one. I'm going to end the poll here. And okay, good. Most of us got it right. This is a little bit of one of those annoying questions where as soon as you see the answer, you're like, oh, brother. Okay, which is what? Intercompany receivables on the consolidated financial statement should be what? Should be 0. Question? And that's just plain annoying, right? Don't miss that question on the exam, please. Okay. All right, good. Let's take a look at, I think I want to look. Did we look at this one already? We looked at this one already, right? Did we?
I don't think so.
Oh, okay. Okay, thank you. Yeah. Go
Yeah,
ahead.
it was like 77, I think.
Okay.
Page
Okay. Good.
77.
Yeah, I think it's the next set of questions, the first one we looked at, or one of them we looked at. So, okay, thank you. So go ahead and I'll put the poll up. Okay, I think we can go to this one. I think there's one person that has checked out, so okay, now they're back. Okay, so let's just go ahead and let's take a look at this one. And let me end the poll. And good, most of us got this right. Now, when you look at this question, you know, it's some exam taking technique here, and that what we have intercompany sales. Now, we know that if we have intercompany sales, okay, we're going to do what? Have to make an adjustment for that. So that's not right. We know that what? Net income is not where the adjustment is made. The adjustment is made on the elements that lead up to the net income. So then you start looking and it says sales and cost of goods sold should be reduced by 80%. No, we get rid of what? 100% of the intercompany sales. And then you say, well, John, whose cost of goods sold are we talking about? Because it's the cost of goods sold of the buyer, then we really should only eliminate the intercompany profit and the cost of goods sold, but they're not giving me that option. I mean, I've gotten rid of A, B, and D, C, and B, so I mean, they must be talking about the cost of goods sold of the seller, right? Okay. Okay, good. Let's look at question 3. Okay, guys, I want to move on. So let's just go ahead and take a look at this one. I don't know, I've got one straggler that seems to be struggling somehow, but let's just go ahead and take a look at this one. Assuming they're going to let me show you the results. Let me end the poll and share results. Okay, stop sharing. Let me close that poll. Okay, and look, we have to put everything back to how it would have looked if this sale never took place, as though the one company that we consolidated has owned this asset the whole time. So if that's the case, and what Poe paid 1.1 for it, then we know that it's either got to be A or B as the answer, because we don't report it at the new purchase price. Okay, so then they're telling me that the machine had accumulated depreciation of 250. So if that's the case, I know that what the accumulated depreciation has to have at least what 250 in it, and not a whole lot of help there because both of the remaining choices contemplate that amount. But I have to do what? I have to take the additional depreciation for that year 10 now. So the original cost was what? 1,100,000. The salvage value, they told me, was what? 100,000 before any of this happened. So they were depreciating $1 million, weren't they? A depreciable base of $1 million. And then they divide that by how many years? The 20 years that they believe this asset has left on its life. And so they would have debited depreciation expense and credited accumulated depreciation if this thing had never happened. The transaction never happened. So the answer is A. Okay. Okay, good. Now, we give you illustrative consolidated financial statements. I've shown you where the non-controlling interests would show on there. You can kind of, quickly glance at those, on your own later if you want. There's really nothing, teachable moments there. Okay. Now, the thing I wanted to show you was the non-controlling interest, and we've looked at that already. How about the statement of cash flows? Statement of cash flows is pretty straightforward after the date of acquisition. Okay. Things after the period of acquisition. Things for the period of acquisition, you got to work with a little bit. Okay, so the net cash spent or received from the acquisition should be reported in the investing section on the statement of cash flows. Okay, now look at that example and you'll see that's very easy. If the parent company spent 2.5 to acquire a subsidiary that has 800,000 of cash, the net decrease in cash of 1.7 would be shown as an investing outflow in the investing section of the statement of cash flows. Now we're going to talk in a separate lecture about statement of cash flows. So if you're not entirely comfortable with the categories, flashcard these, answer any questions associated with these by flashcarding this, and the logic will gel completely when we finally get to our statement of cash flows chapter. I think it's chapter 8. Okay, good. Now, take a look and how will we calculate cash flows from operating activities? Well, we're going to have to analyze now the beginning and ending balances of the current assets, current liabilities to figure out if we had a cash inflow or outflow from operating activities. So a parent company that reported note payable of 600,000 on January 1st, acquired a subsidiary that reported note payable of 250 on the acquisition date. On December 31st, the consolidated balance sheet reported what? Reported 750. So on a consolidated basis, the beginning note payable had 850, didn't it? The ending note payable has what? Has 750. So we have a cash outflow, cash use from operating activity of 100,000. So you just would need to combine what the beginning balances should have been, compare that to the consolidated, and they say this here in the next upcoming paragraph here, paragraph 2.2, about subsequent period, but I think it's worth remembering that statement of cash flows, you do what? You take your income statement, you take your balance sheet, you analyze them, and that's how you prepare the statement of cash flows, right? So we would be analyzing the balance sheet there. It's just that the part that would be interesting would be this part of putting together the beginning notes payable. Now, as I was just alluding to, subsequent period, the preparation of the consolidated statement of cash flows is simplified by the fact that the consolidated balance sheet and income statement would be available. The consolidated statement of cash flows would be, we would be able to now go ahead and just prepare the statement of cash flows from the consolidated statements, okay? But some important reminders here that I want you to flashcard, okay? Let's go ahead and flashcard that. When we use the indirect method or when we're reconciling net income to cash provided by operations, even in the direct method, then we will have to include net income attributed to both the parent and the non-controlling interest. Okay, so that's just a helpful hint there that you should flashcard. The financing section, the financing section should report dividends paid by the subsidiary to non-controlling shareholders. Dividend paid by the subsidiary to the parent should not be reported. Okay, but you will report dividends to non-controlling interest. And the investing section may report the acquisition of additional shares by the parent if the acquisition was on the open market. Okay, so flashcard those sort of helpful hints, I would call them more than anything. You know, the interesting point's going to be up here as to how you prepare that statement of cash flows in the period of acquisition, in the event that the exam goes so far as to ask you to prepare a balance sheet, income statement, and statement of cash flows on a consolidated basis. That would be quite the question if they asked you for all that. Now you come over and we give you a comprehensive example here that I'm going to let you look at on your own. What's nice about it is they give you all the information here. They give you the journal entry at the date of acquisition. And then they give you all the year-end eliminating journal entries. And then they do a nice job in showing you a very comprehensive worksheet as to where all those journal entries that they showed you up there, where they would be placed on this worksheet type of setting here. And so it's worthwhile for you to spend, I'd say, you know, I would spend about a half hour or so carefully going through this and seeing how all these journal entries worked out. And it really addresses almost all of the things that we've been talking about. Okay. Okay, good. So with that, let's go ahead and let's turn our attention to this question here. Keep trying, guys. I'm giving you a little extra time with this one. This is one that on the exam, I could see you spending a good full 3 minutes, which is where we are right about now. But keep going. I'll give you a little extra time. On average, you should spend about 1.5 minutes per question, but some questions like this one are going to take you a little longer. Okay, guys, go ahead and take your choice. We're hitting the 4-minute mark, which is about 1 minute longer than you should spend on any CPA exam question. Okay. And okay, not the best results. And that doesn't surprise me too much because this is a tough question. Okay. This is a question that I would often recommend to my students, just guess. And don't spend a lot of time with this, okay? But let's just go ahead. There is a logic as to how we get to this amount. Now, when you look, and I notice a couple folks just picked the 270, and I kind of get that because you're like, well, I know it's gotta be at least the 270. And if I pick that, I haven't done any harm beyond by thinking other things. So maybe there's a long shot that I've got that right, okay? But no, you can't do that because what? Because this company had a minority, they used to call it minority interest, a non-controlling interest that I have to account for, right? Okay, so I can't, I see why you picked the 270, but, and that's sort of do no harm type thing, but it's gotta be 270 plus the non-controlling interest piece. So this is where this question starts to go down a path of, difficulty. First, I got to figure out, well, what was the non-controlling interest at the time that they bought this? And so they paid what? 120 for 80% of the stock. So if that's the case, 120,000, right? Divided by 80%. 0.80 means that this company was worth what, 150,000? And that means that the non-controlling interest fair market value portion of this was what? 0.20. So that means that at the date of acquisition, when we did our car in big entry at the date of acquisition, we would have created a beginning balance. And I'm just going to analyze non-controlling interest here. We would have created a beginning balance for the non-controlling interest of, what does that come to? 30,000. Okay. So if we had a non-controlling interest of 30,000, now I want to sit here and to get the ending balance, the 1231 balance of non-controlling interest, which is what I need to be able to answer this question, is beginning. And remember, I told you, think of the non-controlling interest section as the statement of retained earnings for the non-controlling interest. So I obviously have to what? Add net income that's attributable to the non-controlling interest, subtract the dividends attributable to non-controlling interest, and then that will give me the ending balance that I need to be able to answer this question, right? Now, when you look, they tell me that there was a dividend of what? A dividend of 5,000, wasn't there?
Yeah.
Okay. But 20% of that belongs to my buddies, the non-controlling interest, right? So I kind of start to turn this into a little bit of a, how you put together the pieces of the puzzle and you kind of match some sky over here. So I'm getting what? The 5,000. Okay. Now I need to figure out the net income. Now, how can I figure out the net income of the subsidiary so that I can figure out what portion belongs to the non-controlling interest? Well, since they gave me what? They gave me the beginning balance in the retained earnings of the subsidiary. I can analyze now the what? The retained earnings of the sub. So I had what? I had beginning balance of 36. The net income is what I'm trying to get here. The dividend that was paid out by the subsidiary was given to me. It was what? 5,000, wasn't it? And then the ending balance in the retained earnings was 51. So if that's the case, ending balance is 51,000. And guys, I do subtotals for things like this when I'm going to have to go up. So what happens? Well, how do I get from by subtracting 5, what number do I have to subtract from? And that answer is going to be what? 51 minus 5 is what? Forgot to write that number down when I was doing this earlier.
It's 46.
46, thank you. 51 minus 5 is 51 minus 5 is 46,000. What happened here? Something's not right. Started out with 36 as my beginning balance, right? There's that. And
I think you want to add the -5 to the 51.
oh, I'm sorry. Correct. Yeah. 51 plus 5 is 56. Thank you. I have to add that, right? So my sub, I'm trying to write my subtotal in there. So 51 plus the 5 means I had 56 before I subtracted the dividend. And how do you get from 36 to 56? You have to do what? You have to add the net income of 20. So if the net income was 20 for the subsidiary, 20,000 times what? 20% means that I have what? 4,000 of income that is attributable to the non-controlling interest. So 30 plus 40 minus 5 gives me an ending balance of 33.
Why did that $5,000 dividend not get multiplied by 20%?
It should have. I should have subtracted it. Well, I did over here. I did when I did the I did a minute ago when I was looking at the net income of 4,000.
I think you had said it, but I think you wrote down the whole 5.
Oh, okay, so I meant to write the 1,000. Sorry. Yeah, so that gives me the 33. Thanks, Matthew. That gives me the 33.
Yes.
Okay, so the dividend, thank you. I think I just wrote it in there, 5,000. Let me show you how I calculated that. It's just so it's showing on the screen here. 5,000 times, you said the 0.2, right? Gives me the 1,000. Okay, so now I know the non-controlling interest ended at 33,000. And so that gives me the 303. Okay, that's a hard question, guys. Like I said, I would get about, 2 minutes into that and just pick C. Or I would think to myself, have I picked a lot of B's or C's, whatever so far, and go from there.
So then you don't have to do anything with the fact that it says that it's being done at the equity method. So, but if it had been done at the cost method, you would have had to do some other stuff, right?
Do they say that it was the equity method?
Yes, style, the investment in style is showing on the parent as equity method, but, and it's because it's showing at equity method that this question is really about the non-controlling interest. And you just add the non-controlling interest, but if it was cost method, you'd have to do something else to it first, right?
I'm having trouble seeing where it said it was, oh, investment in styles at the
At the equity method, yeah,
equity method. That's irrelevant. It's it is, if they were using the cost method, then you would have to adjust the retained earnings of the parent for their share of the net income of the subsidiary. Because if it was on the cost method that they were accounting for this, then the retained earnings would have only reflected the dividend, right?
yeah,
So you would have had to have adjusted the retained earnings to bring in their, to bring in the difference between the net income and the dividend, because the dividend gets subtracted, right?
yeah,
So you'd have to do a little bit of work with the retained earnings to get it to reflect the parent share of the net income so that it's being accounted for at the equity method. But for the equity method, it's okay because we've taken part of the income already. It's already in there.
yeah. That's what I was just trying to,
Yeah. Again, I think I wish that Becker would kind of stop doing that, talking about the equity versus the cost method. First of all, cost method, they don't even call it cost method anymore. They call it fair value through net income. There is no more cost method. It's fair value through net income. And secondly, because they've come up with this fair value through net income method, I guess some funky state, I mean, cobweb company would sit there and account for it at the cost method. I don't know why, because they're lazy or something. It seems to me they'd be using the equity method. But yeah, if they're using cost method to account for the investment, then you're going to have to make an adjustment so that we get the net income of the subsidiary into the retained earnings of the parent, which is where it belongs under the equity method.
great, thank you.
Okay, good. Let's go ahead and we looked at, that's the one we looked at already. So let's jump to this next question. Yeah, go ahead. I'll give you 2 minutes on this one. I really have a problem with this question. I really do. But I'll let you go ahead, and since I had to struggle with it and it's still bothering me, I'm going to let you struggle with it. Okay, guys, let's move on. I mean, take your best choice. Looks like actually most of you are getting it right. Okay, so let's just go ahead and let's take a look at this. Okay, now, okay. I didn't mean to relaunch the poll. So we're done with the poll. Let me get rid of this poll. Most of you got it right. Okay, but let's just stop sharing. Get the poll out of the way. Okay. Now, when you look at this, they tell us that on January 2nd of the current year, Pace Company paid $310,000 to purchase 75% of the voting shares of Surge. Peace reported retained earnings of 80, and Surge reported contributed capital 300,000, retained earnings of 100,000. The purchase difference was attributed to the depreciable assets and remaining useful life of 10 years. Surge reported net income of 20,000 and paid dividends, and this is where they finally start telling me something that's relevant to the question. Paid dividends of 8,000 during the year. Peace reported income exclusive of Surge of 30,000 and paid dividends of 15. And then they asked me on the consolidated statement of retained earnings, what amount should Peace report as dividends? Okay. Now, when I look at this, I'm like, well, I know they got to report 15,000. I mean, that's what they paid. That's the dividend that the parent reports. That's fine. And that's the right answer. But what's bothering me about this question is on my consolidated statement of retained earnings, I would have a column there called non-controlling interest. And that is my non-controlling interest calculation that we've been talking about, which is the beginning balance plus the non-controlling interest share of the net income minus their share of the dividend. And their share of the dividend paid, the 8,000, is going to be the 8,000 times what?
25%.
25%. Is it 20% or 25%?
25%.
Yeah, 25% would be what? 2,000.
Right.
So when I'm looking at this, I'm looking for 17,000
Me
as
too.
and they're showing me 15,000. So I just finally said, F it. I guess I gotta pick 15,000 here, you know. So there's something not right about this question. I gotta be honest with you. And I'm going to ask my contact at Becker, you know, if this question was released by the AICPA, so be it. Maybe the AICPA released it because it's a dumb question. I don't know why they released this question if they released it. And if Becker came up with it, throw it in the garbage. And certainly don't put it in the goddamn class during the discussion of class. So this is really, really super annoying for me. Does anyone else have a different perspective that I can share with them? Okay. All right. So let's just go ahead then. Let's move on to our next module so that we can wrap up chapter 4. Okay. And when we look at, yeah, we got time. When we look at goodwill, we have to consider its impairment, right? So we bring goodwill onto the books when we acquire the assets for more than their fair value. The difference is going to be what? Is going to be goodwill. Okay. Now, when we look at goodwill, okay, we say that under US GAAP, goodwill impairment is calculated at the reporting unit level. Okay, flashcard that, and then you're going to see that this thing is easy. Once you realize that you have to go at the reporting unit level, they'll give you information about different reporting units. You calculate the impairment on goodwill at the reporting unit level. Just flashcard that. And yes, you can have qualitative, okay, evaluation and quantitative evaluation of goodwill. Okay, let's look at this quantitative because from the standpoint of the CPA exam, it's going to be quantitative so that you can sit there and calculate the impairment. So the evaluation of goodwill impairment involves comparing the carrying value of the reporting unit, including goodwill, to the fair value of the reporting unit, including goodwill. If the fair value exceeds the carrying value, there is no impairment. and you should stop. Just put the word stop up there, okay? If the fair value is less than the carrying amount, there is impairment equal to the difference between the fair value and the carrying value. You will then charge impairment against the goodwill, but the impairment cannot exceed the amount that was allocated to goodwill for that reporting unit. Okay, flashcard that. And you can go ahead and flashcard that first part too, where I told you to stop. Okay, and then let's just go look at the example. Just come straight over to the example. Okay, and you'll see what they're talking about with these reporting units and how to treat it. Okay, so you've got Omega Inc., who has 2 reporting units. Alpha and beta. I'm going to have to sit there and calculate the impairment at the reporting unit level, okay? Which includes book value, including goodwill of 5 for alpha and 675 for beta, okay? Alpha reports goodwill of 50 and beta has goodwill of 75. Okay, well, we might have to do something with that, so let's go ahead and highlight that. As part of the company's annual review for goodwill impairment, Omega determined that the fair value, including goodwill of alpha and beta, was 480 for alpha and 700 for beta. Okay, now let's just look at beta quickly. Beta's fine. This is the what? Stop. There is no impairment on this goodwill because we evaluated the reporting unit level. And in this example, we're sitting here and we're seeing that the fair value of the entire company for the prior reporting unit for beta is more than the book value. We're done. We don't have to do anything. Alpha, unfortunately, has a situation where what? Their fair value now has fallen below the book value. So now we have to start to write assets down to bring it to the fair value. And we start with goodwill. And so when we look, we're saying, well, look, there's a $20,000 difference. We have 50,000 in the goodwill account. So since that's the case, we can debit the loss, credit the goodwill. Now we brought alpha down to its fair value 480, and we took that difference against the goodwill. And you would keep going like that if it keeps impairing until you completely wiped out the goodwill. Once the goodwill has been written down to 0, you don't start reporting a negative goodwill. If it continues to drop, it must be other assets that have been impaired, not the goodwill is gone at that point.
I have a question about the issue about at the reporting unit, because don't you also test your intangible assets for that as well, for goodwill impairment?
Well, intangible assets in and of
Or is that just, I guess that's only it is at acquisition, or is that?
Are you talking about specifically identifiable intangibles? Intangibles I've acquired?
Well, yeah, I'm trying to, because it seems like once you've bought a bunch of stuff and you've put them into reporting units, I guess you're only testing at the reporting unit level, and you're no longer testing at the asset level. That's what I'm trying to wrap my brain around.
Okay, well, you do an impairment test for each reporting unit by comparing the fair value to their assets to the book value of their assets, right?
That I got. But
Okay.
I guess then if you have, okay, so once you determine the reporting unit, then you would probably have to figure out within the reporting unit where your impairment is. Is that?
Well, once you have figured out the fair value of the reporting unit, right, then you start to, you compare that to the book value. And if the fair value is below the book value, then you start to have to write down some assets, right? Because
Right.
obviously, so the first asset that gets hit is goodwill.
Right.
Now, if there are other intangibles after you wipe out the goodwill, I'm thinking, that would have to be done on an asset by asset basis at that point. I don't think that they tell us now go against other intangibles. there could be other assets that are driving that lower fair value, right? And you would be writing
Mhm.
those down. But what they're telling you is when it comes to goodwill, if there's a difference between the entire fair value of that reporting unit and the book value, there is no
Okay.
goodwill. Goodwill gets wiped out. You don't start writing down other assets and then saying, okay, now let me, but I still have goodwill.
Okay, thank you.
Yeah. Now, presumably, I would think that, it seems to me that the book value of the assets would have already reflected impairment, right? Because we would have gone through and we would have booked impairment. Remember where we looked at the cash flows and stuff? So we would have looked at impairment of all those individual assets and gone through and already had written them down for their losses. And then we would then have to look at the entire value of the company, right? And if we're sitting there and we have, we have fair value that is less than the book value, then the only thing that could possibly be left at that point really would be the goodwill, right? Because we've already gone through and kind of did an asset by asset. Maybe that's what you're asking the impairment test anyway, right?
Yeah, I
So-
was trying to, we had done goodwill before by asset, and I was trying to wrap my brain around. So when do you do it by the asset and when you do it by the reporting unit? So that's what I was trying to wrap my brain around.
Yeah, and what I'm saying is, if I think what's contemplated here is if there's still at the reporting unit level a amount above fair value left, that's got to go against goodwill.
Okay,
And if there would still be some higher fair value, then I'm questioning, well, what the hell are you doing? What happened to all those assets that you've already brought down to book value?
okay.
I think the assumption is that they would go against fair value, goodwill. That's why you're doing that. Okay, good. Let's go ahead with the little bit of time we have left, guys, and let's knock out these last couple questions. Or I guess this last question. You want the poll, right?
No,
You don't want the poll?
yeah,
Why not? Guys, there's a couple of you that came in here in the last 5 minutes and that ain't gonna cut it. So you will be getting an email from me asking what's going on, why you are missing class. Coming in the last half hour doesn't cut it. So be prepared for an email. Okay, guys, looks like most of us have had a chance to try this one, so I'm going to go ahead and end the poll. You know, most of us got it right. The couple folks chose B, and that's an understandable mistake. What they're asking us is what is the loss that needs to be reported, impairment loss, right? And so the impairment loss is going to be that we had what? Book value of 345, 3,450,000. And they tell me that the fair value is what? 3,310,000. So what happens? Well, when there's a difference like that, I take that against the goodwill. And so the amount of a loss that I'm going to report is going to be what? 140. Now, if they're sitting there and they're telling me that the goodwill was what? 225. And if I subtract 140 from that, what do I get?
$85.
I get 85. Well, that's what's left in the goodwill account, right? After I've taken the impairment. So that may be why you picked the 85, because you were thinking they were asking you about the goodwill account. I would debit the loss, I would credit the goodwill, and then the goodwills and the remaining balance in the goodwill would be 85,000. Question? Okay, guys, that's a wrap on chapter 4. A couple things before we jump off. Don't forget, we do not have class on Veterans Day, November 11th. There will be no class next week. So we will reconvene on the 18th. We will pick up chapter 5, and I have some serious thinking to do about how I'm going to disseminate some of this other material to you, because we are starting to get really kind of seriously behind the 8 ball on our timing. For the couple of folks that came in at the end, you know, you need to adjust that, okay? And I'll be sending you an email. You can't be taking this class for credit and expect that it's just going to be, well, I'll get around to the CPA exam when I feel like it. You know, just give me an age on, that's not going to work. Okay, so I'll be talking to folks about that. I'll be posting this lecture up tomorrow. I think I'm caught up on the lectures. Any other questions before we adjourn? Okay, guys, thanks for your patience. Have a good Veterans Day, and I will see you not next week, but the week after, November 18th, okay?
Thank you, Professor.
Have a
Thank
good
you.
night.
Guys.
Can I bug you really quick, John? I had a quick question about how internships work for credit with GGU and who I talked to about that.
My answer is I don't know. On the first question, how they work. My second answer is like talking to God about it. So you want to talk to, let me stop this recording just so we don't have this whole discussion up there.